Now, economic red flags are rising in Pakistan as the current account deficit has now widened to 256% in just 4 months. The main reason, imports are rising much faster than exports. Even though export earnings have improved slightly, they have not kept up with the pace of the incoming goods, and as a result, the overall trade gap has widened, and October saw the return of a monthly deficit after a brief surplus in September. The trend signals pressure on the rupee and also Pakistan's foreign exchange reserves. Now, the import surge is happening at a time when Pakistan's debt load is already becoming difficult to manage. The public debt has climbed sharply over the past year, driven by weak economic growth and the need for constant external financing. A rising share of government revenue now goes towards interest payments, leaving less room for development and public services. To contain these pressures, Pakistan's central bank has now introduced some stricter rules on the use of the US dollar. Now, cash dollar access is being tightened and banks must now route most foreign currency transactions through digital channels. Meanwhile, the World Bank has delivered a pretty tough assessment of Pakistan's export economy. It has warned that the country's weak export performance is not a short-term issue but the result of decades of inconsistent policies, high energy costs and also an outdated trade agreement. Now, Pakistan's manufacturers continue to struggle with expensive power, slow tax refunds and bureaucratic hurdles, all of which make it harder to compete globally. The bank has said that Pakistan needs a more flexible exchange rate, lower business costs and long-delayed economic reforms, or it risks facing some repeated external crises.